One renowned retirement expert and former Goldman Sachs banker is stepping forward and revealing his number one way to beat inflation. It's a way to receive a nearly 10% yield from the government with virtually no risk. Folks who take the three simple steps he's sharing right now could receive nearly $1,500 from the US Treasury in as little as a few months. Best of all, it's guaranteed by law, and you could pay zero taxes on this low risk investment. Consider how rapidly inflation continues to soar. You don't want to waste any time missing out on the potential profits he believes are in store for this investment. To get a copy of his new free report with all the details, simply go to beatinflationreport.com. Again, that's beatinflationreport.com for a free copy of his new report. Hello, welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the June 14th, 2022. I'm smiling, but it has been a rough start to the week, a rough end to last week. We have interest rates skyrocketing to decade-plus highs. We have stocks falling to yearly lows. What to do now? And a couple stocks that are holding up. All that and much more coming up right now on Making Money. Hi again, this is Matt McCall. It is Making Money. It's the 14th of June, 2022. It is a beautiful Tuesday down here in Nicaragua. Rain last night like it has been doing most nights, but it is very, very beautiful out right now. I can't wait to get some sun and to take my computer out there and do some work during the day. And I'm hoping that as I'm doing this work, we see the market turn up because it has been a pretty ugly last few days, folks. Let's be honest. And after we really had the CPI number come out last week, which I talked about in last week's show, which is consumer prices, we had that number come out and the market really sold off prior to that. And then the number came out on Friday. It sold off even more. And then the sell-off continued on Monday. And I'll show you a chart here in 1 second of the S&P 500 and show you kind of the action that we've been seeing recently. As you can see here, I mean, we had rallied to a 1 month high on the S&P 500. This is SPY, the S&P 500 ETF. And then we gave up all those gains in a matter of literally 3 days. 1, 2, 3. That is Thursday, Friday, Monday. And it is now Tuesday morning. We're down another 0.1% on the low of the session, as you can see there, sitting at a 1-year low on the S&P 500. A lot of people are asking, why? When will it stop? And it's quite fascinating to me because I was watching the basketball game last night, the NBA Finals, sitting around here in Nicaragua at the local restaurant, and it's the busiest I've seen it in a long, long time. Literally, probably 40 or so people in the little restaurant, all watching the game, having a nice dinner, enjoying time, kids running around, and the amount of people that came up to me and were asking me about the stock market was more than I've had in a long time. And it was very negative. Should I sell everything? What should I do? When's the market going to stop falling? It's very reminiscent of not too long ago, late last year, when Bitcoin was above 60,000. And now Bitcoin, we'll talk about that in a second, is down around 22,000, down about 75% from the all-time high of 69,000. And at that point, everybody's asking me, should I buy into Bitcoin? Should I buy into cryptocurrencies? What is a cryptocurrency? What is Bitcoin? What is blockchain, Matt? And everybody was swinging in one direction. I'm feeling the same way now, but the opposite direction when it comes to equities in the stock market. Everybody is really scared. You know what? I'm not going to use the bad word, but there's a lot of negativity. And in a conversation with several people, very, very smart people, about the market itself. And even beyond that, more like the economy, the world itself. And my father called me yesterday. I talked to him about it, and he's ultra conservative. It just the amount of people that are reaching out right now is telling me something. It's telling me that there's some type of event that is about to change dramatically here in the market. Typically, it goes the opposite direction of how people are feeling. It's just how it is. It's the herd mentality, and then market goes the other way. I refer to the sheep and the wolf. You always want to be the wolf, not the sheep. So there's a lot of different analogies and ways to view this. I view it in the light right now of these scare factor, if you will, is so high. The fear factor, I should say, not scare. Fear factor is so high right now that when everybody gets to this level, we're typically at or near. And again, I'm not calling a bottom. And last week's show, I talked about looking at stocks that I thought were hit their bottoms. But I said in that show that the market could continue to go lower. I said the market could hit a new low in this current downtrend, and it has. And I'm not saying I'm super smart by saying that. I just wasn't in the business of calling a market low. Again, I still think some of the stocks I looked at probably have made lows, and maybe not, maybe I'm wrong. But I started discussing last night with a good friend of mine who's an entrepreneur as well, owns some businesses, family lives down here with a few kids. And we were talking about investing. He's a bit risk averse as well, even though he's a little younger than me. Not much in the market, so he wasn't concerned. But also, he's a educated person who realizes the market. And what we were talking about was looking at right now and looking at 3, 5, 10 years. And what you have to realize, in my opinion, is that sure, the headlines right now are high inflation, interest rates going up, mortgage rates spiking, potential bubble in the stock market, potential bubble in the housing market, a war in Ukraine due to Russia. All these things going on right now, most of them extremely negative. At the same time, you have to realize all these innovative mega trends and stocks that I've talked about over the years, they're not stopping what they're doing. They're not stopping innovation. The next iteration of battery technology hasn't stopped. They're not going to stop trying to achieve that. Electric vehicles aren't going to stop and go back to internal combustible engines because of this. It's just not happening. Artificial intelligence, the movement forward of that isn't stopping. We have to think about things logically, that behind the scenes, you may not see it every day. Do you think the future of medicine is stopping? No, it's continuing behind the scenes. So the companies that you love and those trends that you love, sure, they can pull back. And you have to realize that a lot of these great companies have pulled back so many times over the years. And it's not abnormal to see some of the biggest winners in the history of the stock market have major pullbacks like this. And it's not, I can give you examples of Apple, NVIDIA, all of them out there. One of my favorites is Amazon. And you look at Amazon since it went public, which was, let me see, I think it was late 98, 98-ish, right? 97. In that time frame, there's been several pullbacks of 50% or more. 1, 2, 3, 4 pullbacks. However, during that time frame, if you invested $10,000, folks, $10,000, it would be worth $10.5 million right now. And at the high, before the recent pullback that we had, it was worth over $18 million. $18 million from $10,000. But did you weather those pullbacks along the way? Did you succumb to the CNBC and the other news media saying, it's over, Jeff Bezos is a clown? It's tough to hold through this. And there's a lot of stocks I see right now that are in a very similar situation. One, for example, is NVIDIA. NVIDIA is a company that I've talked about on and off for quite some time. It is a semiconductor company that is involved in so many different aspects and so many different of our mega trends. And you go back to when that went public, and I was in the late 90s as well. It's had several pullbacks, believe it or not, of 80%. 3 pullbacks of 80%. 50% pullbacks, even more. It's down 53% right now from the all-time high. And I'm not saying NVIDIA has to be the winner. But what I'm saying is if these trends such as NVIDIA that they're involved in do not continue to move higher, we have bigger issues. So just keep that in mind. Now let's talk about Bitcoin. Bitcoin has had a rough little go of lately. You thought the stock market's been rough, but Bitcoin's taken a big hit. And I know many of my haters out there love to see Bitcoin go down because there's something that they believe where my life is kind of tied to Bitcoin and my life hates gold. It's not the fact. I've said for a long time now that I'm not a fan of gold because I don't think it does what it should do. If people own gold, I hold nothing against them. But to give you an idea, we'll go back to Bitcoin in a second. But let's take a look at GLD, which is the gold ETF. It spiked on Friday, big move. As you can see here in chart, closed at a 1 month high. But now we're down here the last 2 days and huge pullback yesterday to the lowest level in 3 weeks. So again, you have interest rates spiking, you have inflation, a major concern, and gold just isn't going anywhere. I mean, look at gold where it was 1 year ago, same level. Yeah, it's had a run up and a pullback, same level. We have inflation going through the roof, folks, through the roof, 40-year highs. Shouldn't gold be doing much better than this? And again, I don't want to get into the whole gold debate again. I'm just going to irritate people, and they get mad at me because they take things personal. But it's not. You can't debate the fact. You look at this chart; it's gone nowhere. And I've talked about this several times since early 2000, when the CPI, Consumer Price Index, measures inflation here in the United States, was 0.12. Now it's above 8%. In that time frame, gold is now, with this little bit of pullback, is up about 5 to 7% in that time frame when inflation went from 0.12 to over 8%. That's crazy to me. It's not an inflation hedge anymore. It's not a safety hedge anymore. We have a war going on. We have interest rates going up. We have inflation going through the roof. Gold, this is like the time for gold to shine. To give you a bit of a sports analogy, if you're a baseball player and all you can hit is a fastball, you can't hit a curve or a changeup, and all you do is play against fastball pitchers, it should be your prime. You should be doing fantastic. Gold has been dealt this great hand, and it's not working out. So to Bitcoin, either is Bitcoin. Bitcoin's not acting as a hedge either. It's not. If anything, it's moving hand in hand with the NASDAQ. And I've talked about this about a couple weeks ago. It has not been that hedge that I thought it would be right now. It has been considered a risk-on investment. And you're seeing when people panic and sell technology and growth stocks and small caps, which are all considered a little bit more risky, not necessarily they are, but they can consider that. Bitcoin's been lumped into that. And the most recent price of Bitcoin is about 22,200. It was below 21,000 in the last 24 hours. I mean, down from 69,000. I've said this on air many times. I'm a big believer in Bitcoin. I have a lot of my personal money in Bitcoin. And obviously it's going down quite a bit, that portion of my net worth. But at the same time, I said, yeah, I still think it hits a new all-time high at some point. But I also said it could hit 20,000. It can go down. I don't know where the short-term pullback is. Nor do I really care, to be honest with you. At some point, I'll put some more money into it for a run back up. But it hasn't been my concern as a long-term investor. And the same thing we were just talking about NVIDIA. We're talking about the market itself. There are so many great companies out there that are down 60+% that I think it's tough not to buy, but it's very tough to buy. Because again, the pullback of 60% could become 80 before that bottom comes in. But if you're getting out of the market or saying, I can't deal with this anymore, first of all, when you get back in, second of all, you're giving up on the world, because in the history of the world, the markets always come back. So you're giving up on it. And this is not the Great Depression. This is not 2000, where we have the tech bubble where half the companies out there weren't making any revenue, let alone profits. This isn't 2008 where we're highly leveraged and Lehman blows up. This isn't, it's not the same. I'm not saying this is not a rough time. It is, folks. But there's not an underlying bomb ready to go off. And people argue and say, well, the Fed created this bomb by printing money over the last decade or so and artificially keeping interest rates low and now going up, causing inflation to go up. I get it. But what we have to think about is interest rates will go up, yes. My dad, when I spoke to him yesterday, he told me that when he bought one of our first houses as when I was a kid, the mortgage was at 15%. But you also had, CDs and investments paying 11 to 12%. So it kind of goes hand in hand. I mean, if I told you you get 11, 12% every year locked in for the next 10 years, you would all take it. I would put a large portion of my money in there. You'd say, well, it doesn't matter because inflation is that high. Well, inflation will come down. Eventually, that looks like a great investment. Same thing now. Even though inflation is at 8+%, we have wages in the last 12 months up 5.5%. So the real wage growth is actually negative, about 2.5%, because you have to take inflation into consideration. But as I had this discussion with several people last night watching the basketball game, that inflation will come down. But it's very unlikely, extremely unlikely, that your boss or the head of your company will come out and say, you know what, inflation's come down. We're going to take your raise of 5.5% or more that you got in the last 12 months and take it down due to inflation. It's not going to happen. So when inflation comes down, prices come down, your salary is still up there. This is going to be okay, folks. I don't know if the market bottoms today, tomorrow, next month, later this year. I don't know. And I've said that from day one. I do know that things are going to be okay. And I'm extremely confident in that. And if you want to live a different way, good luck. Because there's enough negativity in this world right now. You don't want to live that way. So Jeremy Siegel, who, I don't follow him that closely. He, University of Pennsylvania professor, written some books back in 94, I think was his famous book that he wrote. But has been an economist and market guy for decades. He came out yesterday, and I just want to read a couple quotes he said, because I thought it was pretty fascinating, and it actually aligns with a lot of what I've just said and what I believe. So this is one of his quotes. He said, Jeremy Siegel, "We've had bigger shocks in the past. There may be another 5%. Who knows? There may be another 10%. But that means for me, moving forward, and just raises the return of the market looking forward." He also went on to say, hold in there. If you got cash, begin to, it says employ it. I think I'm going to say deploy it. You won't be sorry a year from now. And he also went on to say that through history, the S&P has beat the CPI, which I just talked about, Consumer Price Index, by 4 to 5% annually per year. So there's a lot you can look into with that. And I agree with a lot what he's saying is that a year from now, and I'm going to go out further because I'm a little bit, not that I'm longer term than Jeremy Siegel, but I like the longer term. And I've been, when I've been talking to people on the phone, in person, through chats, my team, I say, if you have a 3-year time horizon buying some of these companies, you're not going to be sorry in 3 years. Again, I don't know what happens between now and tomorrow or now and October. A lot of things can happen. And speaking of which, we have on Wednesday, midday, the next Federal Reserve meeting. And during this meeting, the Federal Reserve, the consensus was that the Fed was going to raise interest rates by 50 basis points. That was until the CPI came in hot on Friday. And yesterday, Monday morning, according to the Fed Watch, which is they keep an eye on watching action in different vehicles to tell what they think the percentage of certain things that will happen in the Fed meeting. So there was a 3% chance of a 75 basis point rate hike last week before the CPI. So 75 basis points is 0.75%. So 1% is 100 basis points. So there is a 75 basis point hike, had about a 3% chance last week. By Monday morning, that was up to a 30% chance. So a 3 in 10. And it's hanging around there right now around that same level. So You can see just how people have just been freaking out. I still believe we'll probably see 50, but again, I don't know, and I don't necessarily care that much, and I'll tell you why, because it's not as much about the 50 or 75. We know interest rates are going to go up throughout the year and maybe even into 2023 early. To me, it's more about the reaction that we see from the market. And I want to see that action. So for me, when I look at certain stocks and certain potential investments in just the overall market, I don't want to be overly aggressive now. Again, I just told you, I think there's great opportunity, but I think there's going to be great opportunity for a while. I don't think you need to be overly aggressive buying now, because with the Fed coming out tomorrow, and then we have a couple of days after that, I think it's going to be wildly volatile. Put out a daily last week that one of my great analysts, Drew, came up with, and the amount of options expiring this week is legendary. So you're going to see tons and tons of volatility heading into that day, which is Friday. So you add that to the Fed, we're going to have a wild week, folks. We're going to have a really, really wild week. And I know we've had a wild few days already, but I think that really does continue. So that's kind of where I stand here with the market. It's, I always hate to say, like, people are like, what's the market going to do next week? I don't know. What's it going to do in the next 3 years? I think it's hard. And I know you don't want to keep hearing me say, buy, pull back, buy, pull back. I'm just saying you don't want to sell here. And if you have some powder, have some cash on the sidelines, in the next couple of weeks, I think you start deploying it little by little into great companies. Not necessarily the market, but into great companies. My cousin is in finance as well. Been friends since I was born. We're 3 months apart. Talked to him yesterday for a little while. Same thing. And he's always been more conservative than I am. And he worked for BlackRock and a bunch of firms. Now he's at a tech startup. And talking to him, he told me, he's like, yeah, I agree. But individual stocks, innovation, growth, invest in that now, not the market itself. And I can't agree more. You all know how I feel about the ETFs and stuff. I think you need to build your own and buy stocks. But hearing him say that, it was really, again, it just showed that the smart people are now realizing right now. And you know what? At my time at Fox, the amount of billionaires I talked to were a few, and I would say all of them, and it might be wrong, I'm just guessing, but if not majority of them, made their money buying when people were selling. The masses were panicking. And I go back to Wilbur Ross, sitting there with him on air live during the Greek crisis, and they thought the EU was falling apart several years ago. And I remember walking him out to his car and asking him what he's doing. He said he's buying Greek banks. I said, which ones are you buying? But he's actually buying banks, not stocks, but banks. And boy, that turned out to be one heck of a investment. But again, if you told people you were buying Greek banks, you thought you were absolutely out of your mind. But it ended up being, again, a really, really great investment. And they don't all work out, folks. But it's just, you look at it, and there's a reason that these people have become very wealthy, because they've been zigging when everybody else is zagging. So just a couple stocks I want to talk about that have been actually holding up pretty well. One here we'll take a look at is CME Group, which is it's a owner of stock exchanges. CME stands for Chicago Mercantile Exchange, but they own a bunch of different exchanges now. You can see in the chart here, it's kind of all over the place. It is down this year, as you can see. Had a big pullback in April and May, but it was actually up yesterday on big volume, and it was up on Friday as well. 2 days when our market got killed. It is down today about 2%, but it's holding up really well. And the way I look at stock exchanges is in a very good way, that as volatility and more liquidity and more trading comes in the market, they tend to do very well. There's also a big move as far as technology is concerned behind a lot of the stock exchanges. And it's typically a really good place to be in uncertain times. And again, it's just a really weird looking chart, big rollover right there, as you can see, from September hitting a high and then coming down like a lot of the market, but it is held up much better when the market's breaking new lows. This has a double bottom right here, about 185. I see that as huge support. So again, nothing is a buy or sell recommendation, but if I'm looking and I'm not buying this, I don't own it, buying at 198, if it breaks below, give it $5 below 180, you get out. So you have 10% on downside, but upside, huge, back up to where it was. You got big upside to get back just to where it was. And again, I look at these types of companies like this that are often overlooked. It's tough to ignore them. Another one here, again, nothing's a buy or sell recommendation, but I read an article over the weekend talking about some of the large financials that are trading below book value. So Goldman Sachs, symbol GS, this one hasn't held up that well, but you can see here, it hit a new yearly low yesterday. It's up about 1.2% this morning on Tuesday. And it was just at 330 a minute ago, and it was below 280 yesterday. That's a hell of a pullback in a matter of 2 weeks. But below book value. And I think about Goldman Sachs, and I think about some of these large financials that historically, they actually do really well when interest rates go up. And the reason for that is as interest rates go up, their margins of their lending increases because they can lend for higher, but their borrowing costs don't go up at the same velocity. So you actually, that spread gets bigger, which creates a lot more money. And a lot of these companies make a lot of money lending money. So Goldman Sachs and a lot of these large banks that have gotten beaten up, I think you have to start at some point thinking about looking at them. I think you do. I think you just, again, I don't know if yesterday was the bottom, and you could have bought a week and a half ago at 330 and thought you were a genius, and you're already down, $45, 15% or so. So yeah, there are opportunities like this out there right now, and it doesn't always have to be the innovation. I'll show you one other company that was actually up a lot of yesterday, but ended up closing down yesterday, and this is J.M. Smuckers. And if it sounds familiar, they are really well known for their peanut butter and their jelly. Really, stock got crushed in May on earnings, rallied back. It was up yesterday nicely. It was about to break to a new multi-week high and then closed down, and then it's down today another 0.5%. But a company like this, if you really want to just get more defensive and get away from consumer discretionary and more staples, you look at this. Actually 30% of their revenue, believe it or not, comes from animal related, milk bone dog food and stuff like that. The bones for dogs, they are the maker of that. So that stuff, you're probably not going to stop buying your dog bones, and you're probably not going to skimp on your peanut butter if your kids eat peanut butter, or like me, big kid, I eat peanut butter. I don't eat their brand, but I eat peanut butter. You're probably not skimping on that. So a company like this, maybe look at this too. Again, and it's been beaten up from the high, whale down. But let me just show you one thing here. Look at this long-term chart, folks. I mean, you go back to 2000, this stock was below $20. It's at 126 now. It was a high of about 160 almost a couple years ago. It's tough. I mean, that's peanut butter and jelly and dog bones. You invest in good companies on pullbacks like this, you're going to be okay. So again, just think this through logically, and you will be all right. So we're going to do a couple special shows here the rest of the week. We might do a reactionary show to the Fed coming up. And I'm going to do one where I actually review a book and give you some tips and really life lessons of investing. And this is the book right here, Peter Diamandis. And as you've heard, I've talked about this a lot. The Future's Faster Than You Think. It's kind of my Bible, and it's always, I travel with it to Nicaragua with several other books, but it's sitting right here next to me. I always refer to it. I'm going to do a bit of a review of that and kind of help you realize what's in that book if you haven't read it. If you read it like me several times, it's okay. I'm going to still break that down for you later this week as well. So again, thank you so much, folks. And again, keep in mind that the market's going to go through these types of things. It's okay. Since we've been on the air, the market was up, it was down. Now the S&P is up 0.1%. The next few days through Friday's close will be wild due to the Fed, due to the options expiration blowout that we're having on Friday. But just be prepared. And if you're a long-term investor, take the next few days off. Your kids, your grandkids are probably out of school. Go enjoy yourself. It's okay. The market's not going anywhere. All right, folks? All right, so thank you so much for watching. I'm Matt McCall, and that was Making Money.
opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.